If we got a surprise hold, do the markets quickly unwind risk equity positions?
No, I think if we get a surprise hold, risk does well, because actually the economy looks fine. We had the payroll numbers, payroll growth is fine. So the only sort of concern, I think, for risk assets is the Fed actually accelerates the pace of hikes. The hike is fully expected by the market for Wednesday tomorrow. The issue is what they're signaling about the remainder of the year. They had 3 hikes in terms of the dots. Do they signal a shift up in terms of 4 hikes? What's the tone of Yellen's conference in terms of the extent to which they think they're behind the curve? And lastly, the big one, which again I think it's a bit premature for the Fed to really start addressing, is their balance sheet. They've always said that when interest rates get in the order of 1%, they'll start to address their balance sheet and how they reinvest the proceeds. And that's, I think, a debate that's going to take place in the Fed over the next few months.
Let's just run with you on that. So what if there's an acceleration of the rate path and suddenly we're talking 4 and not 3? Does that begin to strangle those sectors that have done well on the idea of higher rates? And those are obviously your classic kind of financials, information technology, utilities that would benefit from that.
No, I think the issue will be, again, it'll be more like the fixed income equities, whether it's real estate, the high dividend equity type plays, rather than the financials. I think the financials still have room to benefit from a higher rate story, in short.
I'm curious about whether we might see some dissenters this week at the Fed. In September, when the Fed didn't raise interest rates, you had 3 dissenters. Could it be the opposite case? Because we know there are some doves on the FOMC who don't want an increase at this point.
Again, that would be a huge surprise. I mean, the big one would be someone like Brainard, who gave a speech recently where she even suggested that the time may be right to start moving rates up in March. And I think, you know, the Fed they've already effectively raised interest rates. The market's reacted to their speeches. I think what they will want to do is not to create more volatility on the back of a rates meeting. So I expect them to actually be much more balanced in terms of their assessment and to emphasize the normalization of interest rates rather than emphasizing we're raising interest rates to slow growth. So we're just raising rates to put them to a more normal setting.
From an investor point of view, what happens if the market fully prices in these 3 interest rate hikes for 2017, which I think we're pretty close to, but the window's closed for whatever unforeseen reason happens, which has happened in the past, the Fed doesn't execute on the rest of the follow-up rate hikes? What does that do to the fixed income investment?
It causes a rally. I mean, the big one obviously is the European election calendar and the risk of populist governments taking control, and I think that would push the Fed, push out the rate hike cycle, and that would be similar to what we saw last year with this volatility in the stock market in the first quarter. Brexit pushed out anticipated Fed rate hikes, so we only got 1 in a year.
So just to be clear, it's the French elections then, and it's German elections?
It's the French, the French is the big one. I think Germany is much less of an issue. The French and possibly the Italians if we get one.